It's 4 minutes to.
Okay, it's 3 o'clock, and a very good welcome to everyone who has joined us today from across Africa and around the world. My name is Faith Ngwane. I am the founder of Wingate Consulting. I am a chartered accountant and I'm a member of the IFRS Sustainability Alliance. Our first webinar focused on IFRS S1 and introduced the foundations of the sustainability related disclosures. So today we move to IFRS S2, which focuses specifically on climate related disclosures and what organizations need to begin implementing today. Before we start, just a few housekeeping announcements. Okay. This webinar is going to be recorded, and we kindly ask that you keep yourselves on mute throughout the presentations. And please feel free to introduce yourselves in the chat by telling us your name and the country you are joining us from. This webinar is interactive, so we encourage you to participate in the polls, and please post the questions in the chat throughout the session. And if your question is directed to a specific speaker, please write the name of the speaker together with the question, and we will answer as many questions as time allows during our Q&A session. So you being here today means you acknowledge that climate reporting is no longer a discussion for the future. And around the world, regulators, investors, and banks, customers even, are increasingly expecting organizations to understand and disclose climate-related risks and opportunities. And for many organizations across Africa, the question is no longer whether to prepare, but it's about how to prepare. And that is exactly why we have assembled today's outstanding panel of experts. We are privileged to be joined by leading sustainability professionals from Nigeria, from United Kingdom, from Turkey and Zimbabwe, who will bring practical implementation experiences from different parts of the world.
Hello, Faith. If you can hear me, you're muted.
Oh,
You've been
okay,
muted.
that's all right. So let me just take you through the introduction again, since you didn't hear anything. Okay, please confirm if you can see my slides. Okay, so welcome to you all who are joining us from around the world today. This is Faith Ngwane. I am a chartered accountant and I'm the founder of Wingate Consulting. Our first webinar focused on IFRS S1 and introduced the foundations of sustainability-related financial disclosures. And today we move into IFRS S2, which focuses specifically on climate-related disclosures and what organizations need to begin to implement these standards today. But before we begin, I have just a few housekeeping announcements. This webinar is being recorded. So, and we also ask you to kindly mute yourselves throughout the presentations. And please feel free to introduce yourself in the chat by telling us your name and the country you are joining us from. And this webinar is meant to be interactive. So we encourage you to participate in the polls and please post questions in the chat throughout the session. And if your question is directed to a specific speaker, please write the name of the speaker together with your question and we will answer as many questions as time allows during our Q&A session. So as we all know, you being here means that you acknowledge that climate related reporting is no longer a discussion of the future. And we see this around the world. Regulators, investors, banks, and customers even are increasingly expecting organizations to understand and disclose climate-related risks and opportunities. And for many organizations across Africa, this question is no longer whether to prepare, but how to prepare. And that is exactly why we have assembled today's outstanding panel of experts. And we are privileged to be joined by leading leading sustainability professionals from Nigeria, from United Kingdom, from Turkey, and from Zimbabwe. And these will bring practical implementation experience from different parts of the world. And today we will start with Grace Fatobi. Grace is a chartered accountant, a fellow chartered accountant. She's an FSA credential holder, and she's IFRS Regulatory Implementation Advisor Program member from Nigeria. She will help us today to understand the foundations of IFRS S2 by explaining the key concepts and the related disclosure requirements. Grace, the floor is yours. Thank you.
Thank you so much, Faith, for that warm introduction. I would just share my presentation. Please confirm I am audible with a thumbs up. Okay, thanks, Eleho, for confirming that. Confirm you can see my presentation slides. Thank you. Okay, good morning, good afternoon, and good evening, depending on where you're joining us from today. My name is Grace Fatobe, and it's a pleasure to be here with you today. We're walking through an African Readiness series, and as mentioned by Faith, we've had one where we looked at the IFRS S1. Our conversation today is to walk through the IFRS S2, but before we go into the IFRS S2, I'll just like to recap what the IFRS S1 is in less than a minute. The IFRS S1 named General Requirements for Disclosure of Sustainability-Related Financial Disclosure is the standard that provides the foundation for reporting using the IFRS sustainability standard. So if you imagine that you're building a house, the very first thing you would do is to put the foundation, and that's exactly what the IFRS S1 is. So the IFRS S1 provides the conceptual foundation for reporting under the IFRS sustainability standard. So that's the standard that tells you the definition of materiality. It tells you what fair presentation is and what a reporting entity also is. Then it goes further after the conceptual foundation to give you what the general requirements for reporting are. So it tells you if you want to report on sustainability. And I would want to pause to say that from the IFRS sustainability perspective, there are 5 dimensions of sustainability issue. So you have environmental, you have social capital, you have human capital, you have business model and innovation, and then last but not the least, leadership and governance. So should you want to report on any of these issues, the IFRS S1 in paragraph 54 refers you to IFRS S2, and then in paragraph 55, it tells you other areas you should go to seek for information outside climate. So let's now come to what we would be discussing today, which is the IFRS S2. IFRS S2 is a climate-related disclosure standards. So when you go to S1 and you pick the conceptual foundation and the general requirements, and then you want to report on climate, you then need to pick IFRS S2. So the most important thing you can take from our conversation today is to know that you cannot use the IFRS S2 in isolation. You must use it in partnership with IFRS S1. So what exactly is the objective of IFRS S2? It requires that organizations should report all their climate-related risk and opportunities that could reasonably be expected to affect the decisions that primary users would take regarding extending resources to an entity or deciding not to extend resources to an entity. So who exactly are these primary users that IFRS S2 and S1 are referring to? We're looking at existing and potential investors, existing and potential lenders, existing and potential creditors. So they are the primary focus of the IFRS sustainability standards. Recall I said that IFRS S2 requires you to disclose on climate-related risk and opportunities. Now, climate-related risks are dimensioned into 2. We have the physical risk, which are the risks arising from the actual impact of climate change. And this would be an example of a climate physical risk would be floods, it would be drought. So anything that is actually happening because the climatic conditions of the world are changing will fall under physical risk. So an example would be, we have some countries and cities that are in low-lying coastal areas. For example, Lagos in Nigeria, we have Accra in Ghana, we have Jakarta in Indonesia, and several other countries. And with the rising sea levels, we find that such locations are incessantly having floods. So what you now need to ask yourself as a business is, am I in any way affected by physical risk, which can be floods, which can be drought? So if we take the examples of the companies, the countries operating maybe in Ghana or Lagos, Nigeria, and their assets are damaged but due to floods, it means that they're going to have increased costs, or even insurance cover would now become more expensive because the insurance company know that this particular company is located in a floodplain and the likelihood of flood damaging their assets is very high. Then we have transition risk. Transition risk relates to any risk that arises because of regulation that has been developed to reduce greenhouse gas emissions, or it could be technological changes that has arisen because you are trying to reduce greenhouse gas emissions. Then finally, opportunities, which seems to be ignored a lot of times. We tend to focus on the risk, but the IFRS S2 wants you to look at both the risk as well as the opportunities. So you need to look at, even though the climatic conditions are changing, are there opportunities for me as a business that I can leverage on to either increase my revenues or reduce my expenses? There's a beautiful example coming out of Zimbabwe that I'd like to use for both transition risk and climate-related opportunities. There's an Eastgate Center in Zimbabwe, and it's a shopping and office complex that has a passive cooling system. So it doesn't rely on air conditioners to cool it. It was actually designed, taking a look at the way termites build their molds. And one interesting thing about this example I want to use is that when it was being designed, the decision to use that model was not necessarily sustainability. The owners of the mall didn't want to incur the cost of installing air conditioners and then the maintenance cost of annually paying for energy using air conditioning. But interestingly, this has now become an opportunity, because if we imagine that Zimbabwe now has an emissions control regulation, which will be a transition risk, Eastgate Mall would actually have an opportunity because it would not reach whatever cap has been given to them, and then they can sell credits to their other competitors who have not used this model. So it's always important to look at the fact that climate does not only come with risk, it also has opportunities, and you need to look carefully and see, oh, there's a risk here. How can my business leverage on this risk and come up with either a product or a service or a means of reducing my cost? So we'll just flip through. I'd already discussed physical risk. So this is an example of a flooded area. Transition risk, like we said, comes from regulation, and then opportunities, which I want us to pay attention to, particularly because most times we just focus on the climate risk and forget that there are opportunities to develop products, to develop services around climate-related change. So what exactly are you supposed to be reporting around climate-related physical risk, transition risk, and then the climate opportunities? IFRS S1 as well as S2 is based on the 4 pillars recommendation of the task force for climate-related financial disclosures. And what they want you to report on is that you should disclose governance. What governance are we talking about? Who in the board, which board committee has oversight responsibility of climate-related risk? Beyond the board, who in executive management has responsibility for climate-related risk and opportunities? And beyond the governance, your strategy, looking at your business model, how resilient is it, considering climate-related risk, both the physical and the transition risk? And are there opportunities that your business model can leverage on to enhance its prospects? Beyond just looking at your strategy, there's also a requirement for you to do scenario analysis. Now, it's important to point out that the IFRS, the International Sustainability Standards Board, understands that not every entity is at the same level. And so it introduced proportionality. And what does proportionality mean? It says that you should not provide information or do scenario analysis you should do it without undue costs or efforts. So if, for instance, as a business, doing a really complex scenario analysis, you do not have the financial resources to engage a consultant, neither do you have the team internally to develop a really complex scenario analysis. The standard understands that there will be such entities, and then it allows you to do a more simplified scenario analysis that you can afford to do without undue cost and effort. So that's one important thing to know. And this proportionality is all over the standard. It doesn't remain on only scenario analysis. It says for everything that you're doing under the IFRS sustainability standards, do not produce anything that is with undue cost or effort. So always pay attention to the fact that, do I have the financial resources to report this really complex model? If I don't, it allows you to report it in a simpler manner with a plan on how you will build your capacity to be able to report very complexly. And the risk management looks at integrating your climate-related risk into your enterprise risk management framework. Finally, the fourth pillar, metrics and targets. The metrics are classified into two under the IFRS S2. We have what is known as the cross-industry metric. And what this simply means is that it is relevant to all entities, irrespective of your business model. So a bank, a mining company, an oil and gas company, a professional services firm would need to look at this cross-industry metrics. It doesn't mean that it is automatically material to you, but it just says that all of these entities should consider this cross-industry metrics, and there are 7 of them. I will talk on greenhouse gas emissions briefly, which is one of the 7. Now, for greenhouse gas emissions, there are 7 greenhouse gases recognized by the Kyoto Protocol. And one of them is carbon dioxide. We have nitrous oxide, and then we also have methane. These 3 are the gases generally released when fossil fuel is combusted. Now, methane comes from fossil fuel, and it also comes from biodegeneration. So if, for instance, you have food that you didn't eat and then you send it to the landfill, eventually when it decomposes, it releases methane. And cattle also releases methane. So it's important to note that not every greenhouse gas necessarily comes from fossil fuel. Now, there are other the other category of metrics is known as industry-based metrics. Now, the industry-based metrics simply means that you have to go to your industry disclosure to identify the material topics that have been identified to be material for your industry using the sustainability industry classification system. So for the industry-based metric, insurance company will go to the insurance industry disclosure. A bank will go to the bank industry disclosure, while an oil and gas exploration and production company will go to the oil and gas exploration and production industry disclosure. Now, it's important to point out that there are some industries that some companies that one industry disclosure may not actually address their own business model. For instance, let's take a food or beverage manufacturing company that has done backward integration and has a farm that provides the grains that it feeds into the manufacturing process. And it also has the logistics asset to move the goods from the company to the end user, or it even probably has a retail store where it sells directly to the end consumers. Now, for that particular food or beverage company, it cannot only refer to the non-alcoholic beverage industry disclosure. It must look at the disclosure for agricultural commodities. It must also look at the disclosure relevant to the logistics as well as the retail business. So it's important to know that you must look at your business model to determine if you fit under only one industry disclosure or you need to look at a number of industry disclosure. And the standard, the industry disclosure always starts off with a description of what that industry, the people in that industry do. So you're never confused as to whether you fit in there or you don't fit in there. Now, in closing, I'd like to say that what I've said may be a lot. You may be hearing it for the first time and you're wondering, Grace, where do I start? I want to close with the fact that climate-related data already exists in your organization. If you check procurement, if you check operations, if you check finance, it's scattered around in the business. For instance, for your greenhouse gas emissions, what you need to do the calculation would be the activity that is resulting in the emissions, which for most companies maybe diesel or petrol, and then an emissions factor. Finance already reports the cost of these things. So the data is scattered around, but it may not necessarily be in the formats that the IFRS X2 requires you to report. So what do you need to do as a business to start? First and foremost, address your governance. Ensure that there's a governance around sustainability, climate-related reporting. Once you've put your governance in place, the board committee, the executive in charge, or a sustainability lead, then you're in a better position to begin to develop your data system. How do you move from the governance? Identify what your material topics are. I listed a number of metrics: greenhouse gases, transition risk, physical risk, opportunities, but not every one of them will be material to you. So you now need to do a materiality assessment to identify which of these numerous metrics or topics can actually impact your cash flow, your access to finance, or your cost of capital. And then once you've done that, the final thing would be for you to now begin the journey. I would close now with this and then hand over to Faith. I would like us to match in the chat boxes which of these greenhouse gases, carbon dioxide, methane, nitrous oxide, do we think is emitted when car exhaust happens, where power plants, fertilizer, landfill, cattle, rice fields, aircraft, and burning vegetation? And please remember that I said that 3 gases are released when you have combustion of fossil fuel, and then some come from biodegradable activity. And then on this note, I would hand over to Faith while you drop your responses in the chat boxes. Faith, over to you. Hello.
Thank you so much, Grace. Thank you. That was an excellent overview of IFRS S2, and you have really helped us to understand not only what the standard requires, but also what climate-related disclosures, why climate-related disclosures matter. I had questions for you, but maybe if we have time after all the presentation, I'll bring them up to you later. So we are moving on to our next presenter, Gegana Tomova. She is an expert in regulatory policy and sustainability strategy with extensive experience across financial services and ESG reporting. She is an IFRS Regulatory Implementation Advisor Program member, and she is based in the United Kingdom. Currently, she is an ESG director in a UK-based consulting firm, and she sits on the board of Net Zero Lawyers Alliance, and she is also a member of the alliance supporting the task force on inequality and social-related financial disclosure. So in this session, she's going practical lessons from organizations that have already started implementing IFRS S2, including and common challenges and practical lessons. Jejana, over to you. Thank you.
Great. Hi, Faith. Just to get a thumbs up if you guys can all hear me and see the slides. Great. So thanks again for being part of this webinar, and thanks for everyone who has joined, and to Grace for doing such a good intro. I'll try not to repeat what Grace has already said, but of course we'll do some scene setting. So as Faith already mentioned, I'm currently working as a consultant in CFGI, it's a UK-based consulting firm, and my background is in translating the regulation into practical solutions globally. And of course, for the last year and a half, it's been heavily dominated by IFRS, both S1 and S2. Just really quick overview, not repeating what Grace was saying, but basically S2 is consistent and building on TCFD's 4 pillars, and it's setting out quite specific disclosures that are designed to be used with IFRS S1, but also in some jurisdictions are building further on what already exists as a disclosure requirement. So this is probably one of the main things to take away from today in terms of how exactly it can apply to different companies globally in different jurisdictions, but also within the Africa region. Basically trying to build on what already exists from a regulation perspective, but also from a business perspective. That's something that really helps shape the discussion when I talk to clients. And ultimately, we've already mentioned what the requirements are in terms of the disclosures, but also the risk assessment, the scenario analysis, and the industry-specific disclosures, which are quite helpful when you first starting to think about what applies to me as a business. Now, just to flag that not all jurisdictions require the adoption of SASB standards. UK is an example of where the regulation does not necessarily mention it, but it can be used, and it's definitely useful to see what could be certain metrics that can be utilized. As again, Grace mentioned already, there is a very specific element within the pillars that actually references the metrics and the targets. But again, really brief overview, we do have the governance pillar, the strategy, the risk management, and the metrics and the targets. And there's a quite important element within S2, and something that firms sometimes it's not necessarily a fear, but they're reluctant to sometimes disclose when something is not available. So there are some examples, especially when it comes to GHG emissions reporting, where the firm or the clients that I've worked with prefers to do a very, very rough estimate rather than say that the number isn't there. So from a practical perspective, this can sometimes work if you assume that the estimates are based on, let's say, industry norms, or other peers have a good example of how they're estimating. However, it's not always really good to do that, because if you know that it will be far off what the business does, sometimes it is better to explain why the information is available. And of course, just to kind of flag that this is depending on how the regulation can be applied, because different jurisdictions have different transition periods and are allowing for different data to be omitted the first year. But something that the IFRS has been pretty clear on from the start is do not strive always for perfection, just report the information in a way that makes sense to the users of your report, and in a way that will remain kind of consistent throughout the years of reporting. Again, another thing is, even if you use some sort of a transition adoption element within the first year, you still will have to think about this properly in the next year. So basically from the get-go, put your hat on of someone who knows your business really well, and start taking the steps of figuring out which elements within S2 and of course S1 will make sense right now. From actual experience perspective, I've chosen 2 case studies because there's quite a few we can talk about, but there's like time limitations. I chose these 2 because they were quite interesting from the perspective of, one is being voluntary. So a bank in the Middle East that I worked with about 2.5 years ago was starting to think about complying with S1 and S2 at the same time, because they knew that there is coming mandatory regulation. Now, doing voluntary compliance before it becomes mandatory helps a business prepare for the regulation. It also offers an opportunity to be a leader on the market. And it really starts these conversations early on, which we, of course, always recommend. However, it's not always good to think about full compliance on voluntary level with absolutely everything within the regulation, especially if it's not mandatory yet. You can actually choose which elements within the requirements make sense to you. So as an example, this bank was starting to think about GHG emissions. They were quite clear, as every financed organization, they already were aware of the transactions that will have an impact for them from GHG emissions reporting. But for them, the main gap in understanding was between the risks and the resilience. So as Grace already mentioned, there's like quite detailed exercise that needs to happen when you evaluate the risks. You evaluate what is material to you. But the resilience element was kind of missing for some of the risks, even though there was a risk matrix and there was a good understanding of what are the priorities for the business. Now, getting deeper into the why it's important to the business, what exactly is the potential financial impact on the firm, and how prepared the business is, was probably the main conversation that was to be had within this firm. And I always advise clients when they start having these discussions to have as many people that have boots on the ground from risk perspective in the room as possible. Also engage with the legal team, engage with the risk team, engage with the climate team, engage with the sustainability team. Again, caveat that not every firm might have multiple teams dealing with these things, but basically the people that will help you understand better how the business operates and what the resilience is should be in the room from the start. Even if it's unclear yet how exactly this resilience will be determined, or let's say from a scenario assessment perspective, whether it's going to be a qualitative or quantitative, or whether the numbers are already present. Having people during these discussions from the start is what makes a difference when it comes to actual reporting. And then it's not always required to start with the really complex things. Again, you can revisit how you determine the risks. You can revisit how exactly your business operates to start building these building blocks of where the reporting will sit, who will be looking after things, and how the data will be gathered. So this is just case study number one, and really help the business actually revisit how much of the the voluntary compliance they could do realistically at this point in time. And we did advise them to delay some of it and be open about it, that it's not full-blown compliance with the full standard. Another example that I like to talk about is a transport company in Australia. This was now a mandatory requirement. The regulation was already in place. Well, it is in place, and they did not have a good understanding of their GHG emissions, even though the business was quite well organized. It's not always straightforward to start gathering the data, especially when you have a mix of, let's say, leased vehicles, your own fleet. There's also difference in how the fuel consumption was being recorded, how much can be automated. Now, what was interesting here, and this might apply to other firms, they could actually borrow some of the methodology and the more complex way of gathering data from some of their subsidiaries. So it's interesting because we usually assume that the parent company will have all the answers and the subsidiaries turn to them for this, but sometimes it's the other way around. So being really clear on what your subsidiaries are doing, the way they are doing it, or even if you don't have subsidiaries, talking to your peers, having a working group, this really helps figure out how to tackle the initial challenges of being compliant, especially when you know that you will have quite complex calculations on your GHG emissions. And even though scope 1 and 2 were the immediate ones that they had to report against, scope 3 was always in the back of our heads. When we were preparing the spreadsheets to start thinking about the final reporting, when we were thinking about, okay, how do we add some of the gases that are not necessarily part of this calculation, we will need to add it further down the line. And then last but not least, where do we put a pin on scope 3 and what will be part of scope 3? So sometimes delaying the scope 3 considerations to further down the line will actually prove more problematic than having the conversation earlier on, even if you're not reporting it. I think that sometimes with these regulations, we do forget that internal awareness and internal reports can be as valuable as external ones. You don't always have to share absolutely everything that you're doing. You can still be prepared internally. And another lesson learned from this was that the parent company was quite keen to automate everything from the start. We advised them against it because even though some of the subsidiaries were more advanced in their approach, and they had dashboards and Power BI, and they had more automated way of gathering the data from, let's say, invoices, the parent company wasn't ready for that. So sometimes a good old Excel spreadsheet where you gather things manually can be the right way to start, depending on how much workforce you have, how much understanding you have of where the data will be coming from. Because ultimately, even if it's automated, you will still have to have this initial check of the correctness of the data. And this is where, of course, assurance will come. But ultimately, you want to be aware of how everything was built before you start making more advanced progress towards reporting. So this is probably, again, a good lesson learned, and the client did actually eventually proceed with automation, but the first year it wasn't. Now, my session is called, of course, Lessons Learned. Again, caveating that there's different challenges depending on where you operate, in which industry you are, how big you are, and also how much you already have existing within the business. Now, I did try to summarize some of the research that's already happened on reports that are out there, and kind of layered it with my own experience. But if we think about the 4 pillars and where some of the challenges are, we can start with governance. Basically, who do you get in the room? Who's responsible for what? Having this clear on paper from day one is something that will really help, even if you're making changes to it down the line. So being clear on who's wearing the hat of assembling everything or signing things off. Having the board oversight. I've mentioned here board oversight. You might not have a board, but having a senior leadership oversight and having the executive accountability is something that you really need to have from the start. And even though the pillar itself is asking you to do it in a schematic way and, be really clear on what type of committees you have, or let's say when you discuss risks, having your own internal understanding of the governance and how it works, even if you don't report it the same way within the report, it's very important. And it's a way to keep control of the reporting going forward. From scenario analysis perspective, that's one of the biggest challenges. Even scenario assessments themselves as a notion, I think sometimes trigger very uncomfortable conversations around the business, because some of them are related to basically uncovering unknowns, but also being aware of the resilience of the business. The challenges and limited internal expertise, but also sometimes it can be lack of clarity on what exactly needs to be in place. And the IFRS framework itself doesn't necessarily tell you what you have to use. They have recommendations, of course, and then the local regulation can give a bit further insight into that. Now, a practical response would be to, of course, start with more simplified initial assessments. Start thinking about it from a narrative perspective. This is my business. These are my risks. These are my scenarios. And this is what the output or the outcome of these scenarios will look like. Of course, it doesn't help that the picture keeps changing and some of the scenario, or let's say some of the degree warming scenarios are no longer being used, or basically if your peers are all using the same scenario and assessment and you want to do a different way, you might have to do some internal convincing. But ultimately, don't start to overcomplicate it from the start. Just do it in a way that will help you understand where the business sits and what will be a useful way to present it to the investors, and then keep building. There's a lot of tools nowadays. There's a lot of data available freely to figure out, based on where you operate and what is your industry, what could be potential outcomes of these scenario assessments. So it's definitely not as hard as it was a year and a half ago. Last but not least, from a scope 3 perspective, there's already like the mention that that Grace said, like around the complexity of the GHG ambitions that sit within scope 3. There is lack of clarity on what exactly will apply to a business. There's always seems to be this element of the further down you go down the value chain, the more elements you uncover. Sometimes we don't even know what equipment is being utilized, what machinery, what type of refrigerant is being used. So this all leads to a bit of a panic approach where you try to scramble something together. Now, something that has worked well is really prioritize the categories that will make sense for the business from a materiality perspective and what would be the high impact. This is something that we're seeing in the US, for example. The GHG reporting requirement was initially talking about broad scope 3 being required after a year, but now the regulation there from a California perspective is talking about basically prioritizing a set of them, let's say 1, 2, and 5, category 1, 2, and 5. I'm just like giving an example. Ultimately, think about what are the material ones to your business, and don't try to have absolutely everything in place. It's better to, again, admit that some data is actually missing. And in all honesty, if you're a very complex business and you have dependency on a lot of suppliers, you might not always have it readily available. This is why being ready in advance with these conversations, even before you have to report scope 3, is useful. But even if with this preparation you still have a lot of gaps, then start thinking about how do you do it progressively rather than aiming for having just a number that will not respond to the business in an actual way. And something that really helps is a supplier engagement. So having an outreach to your suppliers, talking to your procurement team, talking to your supplier relationship team. So it really helps to be aware of what they don't have and make sure that there's enough transparency and connection with them for them to be open to admitting that something is missing rather than falsely reporting something, because then you will be eligible for any legal implications. And then the reporting boundaries, that's something that we discussed also as part of the initial webinar with S1 and also what Grace was talking about. But ultimately, you have to make sure that your reporting entities are clear from the start. So there is sometimes a bit of a difference in how you will approach it depending on how you operate. But ultimately, having assumptions clearly documented and being clear with how it differs from, let's say, the rest of your reporting or some ambitions that you might have had in the past on the business perspective that are not relevant for this report should absolutely be mentioned. And of course, once you have your reporting boundaries, you need to make sure that everything that you're talking about is clear also from a financial impact perspective. Again, going back to the purpose of this type of report, you need to make it useful for the investors and the users of the report from a financial perspective. There was a bit of a whistle stop, and of course, I'll welcome any questions in the chat. Do reach out if you have any questions, but ultimately, I think we're in a really good position now where we're seeing more and more reports against S1 and S2, and we do have a lot more lessons learned than, let's say, 2 years ago. So thank you very much.
Thank you very much, Gegana. I particularly appreciated your practical examples because, you know, they remind us that implementation is a journey rather than a one-time exercise. And I hope others in the audience have learned 1 or 2 lessons from your presentation. Thank you so much. We have a poll coming up on our screens. Please take a minute to just respond to those. What is the biggest mistake? What is one action your organization should take next to prepare for IFRS S2? Is it to identify our climate-related risk and opportunities? Is it starting to collect greenhouse gas emissions data? Is it clarifying roles and responsibilities for climate reporting? Is it assessing scope 3 emissions in supplier data? Thank you for everyone who's responding. Okay, it looks like many people are wanting to identify climate-related risks and opportunities. Others want to clarify roles and responsibilities for climate reporting. It reminds me of the conversation we had during our first webinar that data responsibility is key. And that is exactly what Gegana has reinforced during her presentation. So it is important to have people responsible for climate reporting. Okay, thank you so much for responding to the poll. If you can't see the slides, please try to log in using the Zoom app rather than the web. Okay, moving on to our next speaker, Elif Gokman. She is the founder of Secom Consulting, and she is an IFRS Regulatory Implementation Advisor Program member from Turkey. She will share Turkey's sustainability reporting journey and practical lessons that organizations across Africa can learn from. Elif, we are delighted to have you with us. The floor is yours. Thank you.
Thank you very much for your kind introduction. Can you all hear me? Yes.
You are audible. Thank you.
Great. Thank you. My kindest regards and greetings from Istanbul, Turkey. It's a pleasure for me today to contribute to the second of the Sustainability Readiness Africa webinar series. I would like to start by giving a brief information about myself and my company. I have established Starcom Sustainability Consulting in 2006. It's the first corporate sustainability advisory firm in Turkey. Since then, we have served over 50 large and public companies in 25 different sectors in their sustainability journeys. You might know that Turkey has been the first country to adopt IFRS sustainability standards S1 and S2 with full alignment and naming them TSRS 1 and 2. Although Turkish companies had experience in sustainability reporting for about 2 decades, being the first implementer of ISSB standards, we had a lot of challenges and learned many lessons. The main reason behind the challenges was that the impact disclosures turned to be financial risks and opportunities, and the target audience of the reports almost completely changed to investors. Moving from impact reporting to new standards required a strong mind shift. Turkey's rationale behind this approach was mainly to improve the investment environment. As a summary, to gain international investor trust, to access to green financing, to ease alignment with EU Green Deal and CSRD, and also to reach macroeconomic competitiveness and green transition goals. So today, I would like to share our sustainability reporting journey and the key milestones. I will also provide some data regarding the first year reports, which representatives of regulators and companies might find interesting. Finally, I'll go over the major challenges encountered during the implementation, and finally share some practical recommendations that regulators and organizations can apply as they prepare for ISSB standards adaptation and implementation. I hope you will find the content to be insightful, practical, and consequently valuable. Before I go over the timeline, I would like to give some information on the regulatory structure. The KGK, Public Oversight, Accounting and Auditing Standards Authority, has been authorized to establish and publish sustainability reporting standards in 2022. KGK is a public institution with administrative and financial autonomy, working closely with the Ministry of Treasury and Finance. Here, I will go over each step of the timeline, as I believe it will give you a thorough understanding of how the scene was set before, during, and after adaptation. As you all know, in June 23, the ISSB launched IFRS S1 and S2, establishing the global baseline for sustainability-related financial disclosures. And then after 6 months, TSRS's drafts were released, scope of entities and transition reliefs were announced, and IFRS S1 and S2 were adopted by direct reference and was launched at the end of the year. The first reporting year would be 25 and with a climate first approach. The next 2 years following the launch, the regulator took complementary actions like launching of industry-based guidance, the SASB standards, announcement of reporting training principles. Let's show them to you. Announcement of mandate auditor exam topics, announcement of criteria of training institution accreditation, announcement of mandatory limited assurance, assessment exam to be a sustainability auditors, regulation on mandatory limited assurance, requirements for reporting specialist certification, assessment exam to be a sustainability reporting specialist, and finally extension of transition reliefs for the next reporting period. In the beginning of 26, which was the second year of the reporting, the new thresholds for the reporting entities were announced. In the meantime, in December 25, ISSB has updated the IFRS S2 standard on greenhouse gas emissions. These changes were reflected to the Turkish regulation in July, so they were not effective for the second year. So, up to now, we have already explained the main questions of how, the regulatory process, what, the requirements, when, the timeline based on readiness. And now we come to the most interesting question, who, which entities will be reporting. The regulator made 4 groups of companies and specified thresholds for the scale of the companies. First requirement was to be in one of those 4 groups. The second requirement was to meet the thresholds under specified requirements. Being on the list, if a company exceeded 2 of the 3 thresholds you see on the screen in 2 consecutive years, the company would be in the scope. Although these were clearly described and listed in the regulatory announcements, companies had hard times to understand if they were in scope or not. So the regulator prepared a decision tree to make it easier for companies to understand if they're in scope or not. I will share the 4 groups in the next 2 slides and the related amendments that came later. Here you can see that after the first group was capital market entities. You can see that after first announcements, amendments are made for a few times. Here were the list of market entities, and here are the amendments which mainly covered exclusions, let's say, but I will not go into detail. The next 3 groups were banks and financial institutions, insurance and pension companies, and entities authorized to operate in Istanbul Stock Exchange. Among these, banking and financial sectors list received the highest number of amendments in the coming months in terms of scope of entities. The role of stakeholders were quite important. Looking at the relevant stakeholders, these 3 groups were in the picture: regulators, businesses, and professional bodies. In each of them, for the regulator, the main regulator, the reporting entities, and assurance providers played the leading roles. Sorry. I cannot move my slide. I don't know why. Hold on for a second. I will share again. Yes. We are done with the who question, and as we talked in the beginning, the regulator took bold steps and run detailed processes to accredit training institutions for capacity building. Through these, they wanted to actually control the content and the quality of the trainings. And 11 institutions were accredited so far, and so they were free to organize as many trainings as they can. Trainings are under more demand when there's an assessment exam coming up. I am also one of the 2 accredited trainers of TÜRMOP, which is the Union of Chambers of Certified Public Accountants in Turkey, and it was the first accredited training institution. In total, during the last 3 years, for 3 years, for auditors, 6 exams were organized. 9,000 people took the exams and 500 people passed. The specialist exam was much harder, about 360 people passed among 2,000. These exams are similar to IFRS FSA exams. By the way, I have to tell that Sarkom is the only advisory firm in the country which 100% of the advisory team passed this first exam. And also, yeah, mandatory assurance we talked about, sustainability assurance became mandatory as of September 24 with limited assurance. ISAE 3000 and 3410 are in use now, and the regulator is planning to adopt ISSA 5000 in the coming years and moved on to reasonable assurance. The authorization of assurance providers was also an important and detailed process for the regulator. And today, 50 assurance providers are authorized. To be a sustainability assurance provider, one must be an independent auditor, complete the 70 hours training, and also should pass the exam. Yes, now we come to the interesting part. The next 5 slides are comprised of data from Turkey's first reporting practice. The regulator asked the reporting companies to upload the PDF versions of their reports to a platform called Sustainability Disclosure Reporting Platform, and then through using AI tools, all reports were analyzed. The regulator shared the findings in a large meeting in Istanbul Finance Center, where reporting entities and relevant stakeholders were invited. The numbers you see here are all rounded and derived from my hand notes from my notebook. Here you can see that 365 companies were in scope. Only 276 were uploaded, and among these, 99.3% made use of the reliefs for the first year. Only 2 companies among these 276 uploaded ones, only 2 companies used no reliefs, but among all, actually, only 2 companies used no reliefs, and one of them is Sarkom's client, and one of the representatives are already listening to this webinar here with us. We saw that similar sectors use the same types of reliefs. We said approximately 400 companies were in scope, and also in addition to that, 200 companies prepared their reports on a voluntary basis. Talking about reliefs, there were in the first year there were 5 reliefs described also by the standard. 97% of the companies used no comparative information relief, so they only published the reporting year's data. Climate first approach was used by 92%. Scope 3 exemption was used by 68%. Flexible reporting timeline, the same percentage, and only here we can see that GHG standard is used mostly in Turkey, because only 26% used that relief. On the right side you can see the descriptions of the reliefs, but you already know them, so I will just skip them. Yeah, and some more statistics on GHG targets. 199 companies, about 72%, had disclosed GHG targets. 77% of these targets were quantitative. 24% of the companies had SBTi targets. So you can see that Turkish companies are quite mature on that side. 19% disclosed physical risks, being flood, drought, extreme weather events mainly. And 20% of the companies disclosed climate opportunities. These were mainly financial institutions and manufacturing companies. And the opportunity types were energy efficiency, energy investments, low carbon products and services, and green financing. So although, scope 3, there was this scope 3 emission relief, 45 companies reported on scope 3 emissions, and 5 of these were financial institutions. Yeah, lastly, last but not the least, let's say, metrics and targets disclosures were the toughest for all. Here you can see the proportions of companies that disclosed information on cross-industrial metrics. Here, asset exposed to climate-related risks and opportunities, opportunity-aligned revenue, and transition risk exposures were poorly disclosed. And on the governance metrics, climate capital allocation, back. Internal carbon price and climate-linked remuneration were also not disclosed by most of the companies. Actually, looking at these last 3 disclosures, climate capital allocation had the highest percentage because we already started investments in that area. But looking at the whole picture, almost a little more than half of the companies didn't disclose on any of the climate governance disclosures. Yes, and in general, what were the challenges? Understanding the standards, understanding if we are in scope or not, catching the board's attention, getting the right stakeholders around the table, finding the right advisor and assurance provider, finding budget for both advisory and assurance. What else? Yeah, following up the communication of the authority was also challenging. And in reporting process, collecting data, analyzing and understanding of the impacts of the risks and opportunities of the company's operations and also value chain, implementing scenario analysis, determining these financial impacts in both short, medium, and long term, and deciding on the limits of how much to disclose was also a challenge. So this list could be a longer one, but I tried to put together and emphasize on the most strategic and critical ones. Get the board on board, that's very critical. Build capacity, understand the concept of integration, start measuring your emissions, understand your value chain, concentrate on only the material risks and opportunities, not everything. You cannot cover everything. Regulators, if there are any regulators in the room, I really highly recommend that they implement readiness assessment for the country, for the jurisdiction, plan the phases due to readiness, clearly describe the scope of the reporting entities, determine who is in the scope before they know it, and communicate your decisions clearly. And yet, yes, you might all know that COP31 will take place in Turkey this year in Antalya. And if you're able to come, we would love to see you there in November. Yeah. And thank you for listening.
Thank you so much, Alif. It's always valuable to learn from countries that have already traveled part of the journey. So thank you so much for your well-researched presentation. Many of your lessons are directly applicable to organizations across Africa. So thank you so much. Really appreciate it.
Thank you for having me.
Okay, we are moving next to our final speaker, Rudoku Bare. She is a chartered accountant and group accountant at Cicada in Zimbabwe. She will share practical experiences from an organization that's implementing climate-related reporting, and she will discuss what this journey looks like from within a business. But before we get into Rudo's presentation, she has prepared something special for us, a very short video to give us a practical glimpse into the reality behind reporting. So please allow me to share my screen and then I will play the video. Please give me a thumbs up if you can hear.
It's a very simple idea. We only have one home as a human race, and that is this planet. And its capacity to regenerate and renew itself is finite. So for us to be good stewards of land assets, we have to conserve them, and we have to minimize the harm that we do to the environment.
You know, as a business, we take an ecosystem approach. We are managing multiple forests, plantations, etc., but they all depend on a functioning ecosystem. So if we don't look after our surrounding ecosystem, we're not going to be able to produce all the products that we as a commercial business are trying to produce and sell.
Cicada agriculture doesn't make anything. We grow things. Our entire business relies on natural processes to work. Even though we manage those natural processes, when we sell an avocado, we didn't make that. It grew on a tree. And the reason it grew on a tree is because the tree was healthy and that the soil was healthy and that the environment was healthy and that the pollinators were able to pollinate the flowers and that there was a balanced pest pressure that was moderated by predators and so on.
Everything we grow comes from the soil. And to ensure our long-term success, it's important that we invest today in ensuring the sustainability of those ecosystems.
This is actually really a fundamental part of our business. It's not a nice to have CSR thing where we go and plant 500 trees at tree planting day and say that we've done the job, right? Actually, if we want to run this business, we have to have the help of the environment. In our estates, in the land that we directly manage, we have set aside 30% for conservation, and actually it's much more than 30%. In our ag portfolio, we have 6,000 hectares altogether, and 4,000 of that is conservation.
We have done a huge stretch to say 30% at least of each estate will be put under conservation. And we're trying to link those, make sure that they're corridors. So any wildlife that exists in one part of that has actually got a safe corridor, can move through to another.
Thank you. Thank you so much, Faith, for setting the stage on our journey as Cicada, as we take the sustainability into numbers. Thank you very much. Let me just share. A thumbs up if you can see my screen. So today I want to share how we are approaching IFRS 2 implementation at Cicada, from the farm all the way to the reports. And importantly, thank you, just being assisted here. Just confirm if you can see my screen, Faith.
I could see it, but currently I can't see your screen.
Just a minute.
Do you want me to share from my end?
Okay, you can share from your end. Thank you. Let me stop sharing. Okay, you can share from your end. Thank you, Faye. So today I want to share how we are approaching IFRS 2 implementation at Cicada from the farm all the way to the report. And importantly, this isn't just about producing another disclosure. It is about building a system that allows us to understand how climate-related matters affect the business. And hopefully, by the end of this presentation, IFRS S2 will feel slightly less intimidating. You can move on to the next slide, Faith. Thank you. Before getting into IFRS S2, it is useful to understand the environment in which we operate. Cicada is made up of 4 business units, that is the agriculture, forestry, carbon, and solar. In agriculture, we export macadamias, avocados. Locally, we sell cereal crops, that's your soya, your wheat, and your barley. In our forestry, we sell timber. For carbon, we have distributed around 100,000 cook stoves around the country, and these are generating carbon credits. For solar, we're doing some pipeline projects right around the country as well. Because climate-related risks and opportunities can arise across virtually every part of this business, they affect agricultural yields, water availability, energy consumption, fuel costs, even investment decisions. So our starting point was simply asking, what do we need to disclose? The better question was, what is actually happening operationally and what information does that generate? So our sustainability strategy is built on 3 principles. 1, finite planet, that you saw in the video just now. People first, and measurable impact. I, particularly being a finance person, I'm more interested in measurable impact because it links very naturally to what we are trying to achieve through IFRS S2. And I think that is particularly relevant for climate reporting. We can have excellent sustainability ambitions, but unless we have reliable data, we don't really know whether we are making progress. So the challenge becomes, how do we turn our sustainability ambitions into measurable information? And this takes us to our implementation roadmap. So one of the few questions we often get is, if IFRS S2 implementation in Zimbabwe is set for 2028 for Category 1 companies, when do we actually start? And our answer is, we don't start in 2028. 2028 is the year of first implementation. The work starts much, much earlier. For Cicada, our first phase began in 2024 with the sustainability strategy and establishing our baseline. We then are interested in moving to the gap assessment, where we identify what information we already have, what is missing, and who owns the data and which systems are being used. 2027, we plan to build and pilot our reporting process right up to board level and get it approved. This will be an effective dress rehearsal, and I think it is important because you don't want your IFRS S2 reporting cycle to be your first attempt at understanding the data that you have. By 2028, we produce our first disclosures in our financial statements. 2028 to 2029, assurance ready, and beyond, our objective is continuous improvement. So for us, 2028 is not the starting line. It is the point at which all the preparation that we've done over the couple of years comes together. You can move to the next slide, Faith. Thank you. Once we have the data, the next question is, who is responsible for it? And this is where governance becomes important. At the top, we've got our board and our audit committee providing oversight and approving the core sustainability strategies and policies. The sustainability committee drives the execution, while management, the team that you saw in the video earlier, produces the reports and reports to the board every quarter. But perhaps the most important point here is that sustainability reporting cannot be owned by the sustainability team alone. We do have a chief of staff and sustainability officer. It has to be an integrated report put into our budgets, long-term planning, risk management, and internal controls. And I think this is one of the biggest lessons from implementation, that governance systems and reporting do not happen over time. It requires collaboration between the board, management, finance, the ESG team, and the operational teams. You can move to the next slide, Faith. Thank you. So let's expand our principles a little bit. This slide is where we start connecting our sustainability targets to actual climate metrics. For example, we have a target that all estates will utilize 100% renewable energy by 2030. That's our target. To understand progress towards that target, we need information from activities such as irrigation, the climate metric being electricity and water consumption. A solar installation is a transition opportunity. We can measure the percentage of the energy coming from these renewable sources. And for our supply chain, we need to consider supplier and transport emissions as well. The important point here is that these are not simply ESG activities sitting in isolation. They generate measurable data. That data can then be analyzed to understand climate-related risks, opportunities, emissions, and resilience. For example, if diesel consumption is increasing, that may indicate increasing Scope 1 emissions, but it may also indicate increasing exposure to fuel prices. If we invest in solar, we may reduce diesel consumption, reduce emissions, and potentially reduce exposure to energy transition and price risks. So we are trying to move from this is our sustainability target to this is the operational activity, this is the data it generates, this is the climate metric, and this is why it matters to the business. You can go to the next slide, Faith. Thank you. You can go to the next slide, Faith. Thank you. So this is another important part of our approach. We talk about full capital accounting. That's financial, carbon, human, natural, environmental impact quotient. That being a calculation and comparison of the environmental and health risks of agricultural pesticides. Why do we say so? Because we want to understand the relationship between our financial capital and our environmental and operational impacts. Let me give you an example shown on the slide. Suppose we invest in solar. The first thing finance is CapEx, but operationally, that solar investment may reduce diesel or electricity consumption. That reduction can reduce Scope 1 emissions. It can also reduce exposure to fuel price and transition risks. So suddenly, the original capital investment has a climate-related story attached to it. And this is where finance becomes particularly important. Finance can help connect the operational information to financial impacts and decision-making. So the message here is IFRS S2 shouldn't be a separate sustainability spreadsheet sitting somewhere in the organization. It needs to connect to the systems and information that the business already uses. Can move to the next slide, Faith. Thank you.
No, I've moved to the next slide, but I can see it's not showing yet.
Okay, it's showing now. Thanks.
Okay.
Lastly, we move to people first. Now, an important distinction here is that IFRS S2 is focused specifically on climate-related risks and opportunities. So employee and social matters are not the main focus of IFRS S2. Our approach is therefore to consider these areas under IFRS S1, that is your health and safety, your training, employee retention, diversity, and working conditions. And I think this distinction is important because sustainability reporting is broader than climate reporting. Not everything that is ESG is IFRS S2. Let us be reminded of that, but that doesn't mean it isn't important. Who actually collects all this information? We may all ask. You can move to the next slide, Faith. Thank you.
I don't know, may go ahead. I don't know if the screen is not showing, but from my side, I'm to the next slide. So you can just go ahead.
That's fine.
Thank you.
That's all right. Thanks. So it's everyone's responsibility. The estate manager for us, Cicada, may be responsible for information such as hectares planted, irrigation volumes, fuel consumption. Procurement may be involved in the supply and transport information. HR provides information around people. The ESG team then helps to have the sustainability strategy and also assist in converting the operational information into climate-related metrics. Finance then coordinates, reconciles, analyzes, and ultimately connects the information to financial reporting. So climate data should not sit with one department. It needs to be a cross-functional process. When setting up structures, each person then needs to ask, what data am I responsible for? What unit do I report it in? How frequently? Who reviews it? And what is it ultimately being used for? Of course, this all sounds much easier when put on a slide. In reality, collecting data comes with its challenges, some of them listed here. We have manual recording, different units of measure, historical information that is missing, limited technical knowledge, challenges obtaining scope 3 information from suppliers. Our Zimbabwean audience will understand how difficult this is. And sometimes, quite simply, nobody knows who owns the data. Our approach is to deal with these issues systematically. For manual processes, we introduced standardized templates, which we do hope in the near future will digitize them soon and link with our current accounting system. For missing historical data, ourselves, we've established our base year, which is 2024. And for those that have not established yet, this is where you need to start now to build your data. And perhaps more importantly, to update job descriptions so that data ownership becomes part of someone's actual responsibility. Because if everyone owns the data, there's a danger that nobody owns the data. Finally, we need to connect climate data to financial data. This is where regular ESG and finance meetings and interactions are important. We just need to understand how many tons of emissions did we generate, but what does this mean for financial information for the business? So as I bring this presentation to a close, I think there is one key message I would leave with you. IFRS S2 should not be viewed simply as a compliance exercise. It's an opportunity for agribusinesses and other businesses as well to understand how climate change can influence their operations, their people, their strategy, and ultimately the financial performance. For us, the journey begins where the business begins. That is the farm. Every little fuel, hectare cultivated, liter of water, unit of electricity, all that creates data. And we need to capture it consistently and analyze it. And most importantly, we need to connect it to our financial information for business decisions. So ultimately, our approach is quite simple. Start with the operations, and for us, it's the farm. Understand the data, assign ownership, build the systems, connect climate information to financial information, and then build towards assurance-ready IFRS S1 and S2 reporting. Because 2028 may be the year of implementation for our Zimbabwean audience, but the quality of that disclosure will depend on the work that you've done before 2028. And perhaps the biggest lesson for us is don't wait until you have the perfect data to start. Start with what you have, understand the gaps, and improve from there. Thank you. Thank you very much. Thanks, Faith.
Thank you so much, Rudo. One of the strengths of today's webinar has been moving from the principles of IFRS to practical implementation. And in that video, hearing directly from the CEO about taking responsibility of the environment really shows that IFRS S2 is not just about reporting, and action across the organization. I have one question for you, Rudo. What is one practical lesson from your implementation experience that you believe African organizations should take seriously as they begin implementing or preparing for IFRS S2?
I think generally as professionals, we've come to being so used to starting when things are perfect. We want perfect reports. We want full information. That's how we've been taught. But I think with where we are now, especially the Zimbabwean audience, it's good to start collating your data now. The little that you have, whatever is there, put your assumptions on paper, build as you go, because very, very soon, 2028 is going to be here, especially for category 1 companies. And you then don't want to be found scrounging around for information around your departments. This is a cross-functional process and it's cumbersome. So you really then need to start with what you have.
Okay, thank you so much for that, Rudo. We don't have any questions from our chat, but I'm gonna ask a question to Gegana. What biggest mistake organizations make when they first begin measuring greenhouse gas emissions? Would you just answer us, please?
Of course. I think I kind of alluded to it during my bit of the presentation as well, but I think it's this element of assuming that you have to be as good as the next peer next to you. So having this notion that it's something that you have not thought about before, or the organization does not have enough information internally, has been a bit of a blocker. And sometimes it can be solved by, again, taking a step back and thinking about, okay, this is where I operate. This is what I already know about how I track my spend, where the business is spending their money, what do we lease, what are the GHG emissions associated with this. Simplify it and have these relationship categories early on. I think trying again to start thinking about each of the categories, let's say within 3, for example, or doing location-based or market-based when you're not aware that it applies to you, for example, is something that can be more of a blocker than actually helpful. So again, think about where the business is operating, what are your main activities, what is the sector you operate, learn from what the others are doing next to you, but don't try to always be at the same level if you're not ready for it, and especially if you have not done it before. And last but not least, try to rely on tools that are out there that can give you a good understanding of what you can realistically expect. And last but not least, communication. So trying to solve everything on your own without engaging the wider team and other business areas can sometimes be quite unhelpful. So I would recommend against that.
Thank you so much for that, Gegana. We come to the end of the webinar. I would like to sincerely thank each of our speakers, Grace, Gegana, Elif, and Rudo. Thank you for generously sharing your knowledge and practical experiences with us. And to everyone who joined us today, thank you for investing your time and strengthening sustainability reporting across Africa. We would like to thank our sponsors, Wingate Consulting and Price Capital, and everyone who has worked behind the scenes to make this webinar a success. And if you have any questions after this webinar, please reach out to the contact appearing on your screens right now. Will be able to assist you. And I would like to share something exciting that we'll be hosting an in-person workshop in Harare on the 10th and 11th of September. And one of these ladies, I won't share now, but one of these ladies from the IFRS Regulatory Implementation Group will be there. So if you'd like to attend, on the same contacts on your screen, and we'll be more. We hope that today's discussion has provided you practical ideas and begin options. So on behalf of the team, I would like to thank you, and I hope